So good afternoon, everyone. I hope you're enjoying the summit so far. Thank you for joining us today to discuss the rise of private credit, along with its significant benefits and risks. I'm Audrie Chad, Research Director at the Global Risk Institute, and your moderator for today. We have four fantastic speakers for you today. John Trivieri to my left, CRO of Meridian Credit Union. Jérôme Marquis, who's Managing Director and Head of Corporate Credit for CDPQ Fixed Income. Next to him is Tony Peccia, former Citibank CRO and Managing Director of several leading global banks and an executive in residence at GRI. And last but not least, Christian Hensley, Senior Advisor to Avondale Private Capital. So we will have time for Q&A at the end of today's session, and there will be a mic runner in the audience, so please do keep your questions, and we will invite you to ask them towards the end of the session. So without further ado, let's get straight into it. I'd like to invite each of our panelists to provide a brief introduction on their background and how it relates to private credit. So John, let's start with you.
Sure.
Tell us a bit about your role and your mandate and how private credit relates to your operation.
So I started in banking and lending right from graduating from my MBA and got into commercial lending. That is kind of morphed its way to getting on a large sales team, leading a large sales team, and then leaving the banking industry and going into private practice with respect to one of my clients, which then led me to get into more consulting. And on the consulting side, I always seem to be doing, I'm going to call them large, high net worth family restructures, but positive restructures, because restructure has a negative connotation to it sometimes. So positive restructures, which then got me involved at Meridian Credit Union on the credit side, which then morphed into becoming the Chief Risk Officer. So as far as how it relates to this topic, my background is predominantly real estate and restructures. And I'm not going to talk specifically about the larger private equity firms. We have other colleagues on the panel that'll talk to that. I'm going to talk more at the mid-market or the localized private lending that happens in different communities. And my answers will be geared around that, specifically to how Meridian Credit Union faces dealing with private lending.
Thank you, John. Jérôme, over to you.
Hi, happy to be in Toronto, even though I'm not a Leafs fan, so look out.
You have some safety up here. I'm a Habs fan as well.
So I've been so happy to be here. I've been at CDPQ since '99. I'm originally a lawyer, but I've been credit is the only thing I've done in my life. So, but credit has evolved. So I had all the corporate credit team, about $32 billion. We got about 35 people, 3 offices. 60% of what we do is private. 40% is public, so we'll talk about private, but there's also public, and both have advantages. And that's not the only thing private credit we do internally. We have another infrastructure debt team. We got a real estate debt team, so I'm part of the private debt initiative. And I know I'm talking to a risk conference, but I'm an investment person. But the way I feel it is I'm the first line of defense. So I definitely I feel part of the risk conference here, even though I'm an investment person.
Thank you, Jérôme. Tony, over to you.
So I'm Tony Peccia. I was the former Chief Risk Officer for Citibank Canada. My experience in private credit is indirect. So Citibank generally dealt for many years only with top-tier corporates, and recently got involved in commercial banking, which from a city perspective is slightly different than the Canadian definition of that. But it's anything in Canada might be even called corporate. But there's a lot of overlap between the commercial banking clients that we had at Citi and the private credit. It's not one for one, but there is a significant overlap, and it was quite an eye-opener to me, the significant different credit profiles of the market that we were targeting. So it's very similar to the market for private credit. I've since left Citi, and I'm enjoying 2 activities that I'm doing right now. One is I'm founder and CEO of an AI company based out of Miami, actually, and I do a family private equity deal, so I'm involved in structuring some of those. And one of the reasons I wasn't here this morning, I was involved in that transaction. So
You're
that's my
excused.
background.
Thanks, Tony. Christian, over to you.
Great. Happy to go last as well, so I can try to wrap it up. But I started my career in middle market private equity in New York, so I was an enthusiastic consumer of private credit. That was my baptism by fire. Joined the structured equity program at CPPIB in 2012, ran that program, and then joined IMCO and ran their public and private equity and credit business lines. And in that context, constructed and built and scaled a $10 billion credit program that was substantially dedicated to the private space, but also looking for improved beta and other exposures on the structured credit side as well as the real asset side. I left that about a year ago and joined a group called Avondale, which I found is filling a really interesting need and niche in the sustainable credit side, having been a program manager desperate for more capacity in that space, finding a group that's actually going out there and funding those businesses on the credit side to help with energy transition and other forms of infrastructure I thought was very rewarding, and that's what I'm happy to be doing now. So that's my exposure to credit.
Thank you. So as you can see, we have a very fulsome and esteemed panel with a lot of different expertise in different areas of private credit. But what is private credit? Because we kind of talk about it without defining it per se, and I'm going to ask John to kick it off and really give us some color around what are we talking about when we refer to private credit, and then where's the direction of our conversation going today?
So I'm not going to get deep into the private equities piece specifically, but I can tell you at Meridian, we look at private equity today through our syndications desk, where we started it about four and a half years ago, where we've been deeply involved in financing private equity acquisitions. And I touch on that just because that is something that Meridian offers today in the market. I think it's about a $3 billion book and has been quite successful over the last 4 or 5 years. What private equity for me is or what I see a lot more today or in the last 5 years has been, think of, there's been a lot of articles in the newspaper about what's going on with variable rate mortgages. And I can tell you at Meridian, where we've had to solve a lot of the variable rate mortgage dilemma that's taken place, is a result of the bank of mom and dad. And I don't know if you guys have heard of the bank of mom and dad, but those are the folks that seem to be bringing resilience to the mortgage market relative to lending money to their kids or grandkids. We see a lot of private lending, very small private lending in the real estate industry, specific to small builders, small unit builders, small quantity unit builders in construction. So someone that's building 4 or 5 houses a year, they struggle to put together a financial package that can meet the requirements of whether it's a credit union or a bank, that they go to the private markets. Everybody in this room probably knows someone in their community that does some level of private lending. And I know we're going to talk about risks and things that come with private lending, but we're seeing that on the rise substantially over the last 5 years. Since the start of COVID to now, we've seen more people in that, what I call mid-market private lending. And that level of private lending, we're seeing it hit levels of 10, 15, 20, $25 million of mezz financing behind senior debt stacks, where then when we're doing the senior debt stack, we have an opportunity to talk to those people, the second tier lender, to say, hey, why are you doing this? What are you doing? And are you going to be able to meet our requirements to make sure that we get a standstill for you? So the gamut runs from, $10,000 that your best friend asks you for, to what you're going to hear from the rest of the folks on the panel.
Thank you. And with that, Jérôme, I'd love to hear from you as to what role private capital plays within your institution and how you view it.
Before that, I'll go on to what you mentioned. What is private credit? Because private credit has a broad definition. It means different things to different people. So just again, my own definition, and it's broad, but because for us, private credit is not only direct lending. Some people will say private credit is direct lending. That's corporate. For us, it's also infrastructure. It's also real estate. So for me, private credit, and I wrote it down, it's a loan made by a single or club of institutional investors to a company or an asset. So ultimately, it started to go around banks. We'll go there later on, but it's broad. That's the broad definition. Then you can narrow it down to a corporate. What is the role? And that's a key. For us, for an institutional investor, private credit is definitely key. It is growing. And you got three things why it's important for a pension fund or an institutional investor. You got recurring revenues. You're clipping coupon. And then you got downside protection. We'll go there later on. What is the advantages of a private debt for a lender? I mean, there's also advantages for a borrower, but what is the advantage for a lender? And last thing is additional return. It pays more than if I buy a public bonds in the market. So why is it important for a firm like us, private credit? What are the advantages for a pension fund? You got four. You got four advantages. First one, when someone calls me, private debt, due diligence. I'm going to spend a month, 2 months, we're going to be spending due diligence your company directly. So we're going to be talking to each other, asking questions. We're going to do your company inside out. I'm not buying stuff on the public markets where I know a lot less. So due diligence deeper. The second thing is, the second advantages is legal docs. Usually, generally, the legal doc in the private debt space is tighter than on the public market. So we negotiate directly with you. You'll want flexibility. That's one of your advantages. But we'll want tighter docs. So that's the second advantage for us. Third thing is, because we're going to give you flexibility and things that you want, we'll get paid more, less liquidity. So we don't see an additional risk, but we get paid more. And the fourth thing is, if things don't go well, to restructure, at least if things don't go well, or we just portfolio management, we talk to you. We know what's going on in your company. So we got a lot better knowledge, so we can follow up what's going on in our investment. So 4 reasons why private credit is key for a pension fund, key for institutional investors. We get paid more, and we feel risk is controlled or understood. I stop here.
Thank you. I mean, that paints a really good picture as to what the attributes are of private credit and how it can show up and look like in different institutions. Presumably that has been available, but perhaps not as well utilized in the past, let's say call it a decade or two ago, and it's really taken off. So Christian, can I ask you to comment on what's been the catalyst to drive the momentum in the last 10 years that we've seen in the private credit market?
Well, I think like any successful product, I think it builds its own momentum in some ways, and the channels that supply it have grown in concert with that. Mm-hmm. I think you have some regulatory constraints that have also pushed capital away from traditional banks and into the private capital space. The overall expansion of the private markets side of the equation in equity has also been a big contributing factor, as many of the corporate loans we've talked about are happening through the private equity channel. So there's a synergistic relationship between the expansion of that business and its success and the flows that are going into the private capital side. And I think the other thing I'll point out is many of our successful friends and peers on the institutional side, they feel comfort with past success. And so it's now more conventional, I would say, arguably, to chase the returns that many had achieved in the past. And we've seen that in a few asset classes, infrastructure, and others. I think credit has itself benefited from that overall technical supply of capital flowing in. I still think there's really compelling opportunity that remains. And I think the premia, Jérôme, that you're talking about of illiquidity and complexity does pay dividends, no pun intended, in the space. But I think we do have an inflection point that we're all addressing now, where that supply of capital is running up against a little bit of uncertain and fluctuating demand on the deal flow side, particularly in private equity. So it'll be interesting to see how that balances out.
And Jérôme, did you want to add anything there in terms of what is generating the momentum from your perspective with your organization? Because it might be different as you look at sort of subclasses of private credit.
It's a good point. I mean, the regulatory aspect, if you start initially, I've been in CDPQ since '99, and I said credit has evolved. The regulatory aspect is definitely one of them. The second thing is, in the 80s, let's say early 80s, there were 14,000 banks in the US. banks consolidated in the US. There are now 4,000 banks. And many regional banks have been bought out by larger banks. So regulatory is one, consolidation of banks, two. So what happens in the past 10 years is private credit grew 15% per year. So many times I'm being asked, is there a bubble? Is there too much capital? Now there is, because there's not enough M&A. But what people tend to forget is, well, private credit is about $1.7 trillion. That's the space. What people tend to forget is PE grew 15% as well. It's a $7 trillion space. So everyone grew. So all the and infrastructure, PE grew. All the private assets grew. So that's one thing. The second thing is, what are the advantages for a borrower now to use private credit? Because it pays more. That borrower will usually pay more than if it goes on the public market. And there are a few of them. Let me get my notes. I'm getting. So definitely one of them is certainty of execution. So instead of going to the capital markets and capital markets open or not open, you get a call, you provide a certainty of execution. That's one of them. The second thing is flexibility. Usually when a borrower wants money from us, he wants to make acquisition. So you provide them maybe delayed draw term loans to make sure that they can buy companies. Maybe he wants to pick interest for a few quarters. Maybe so you're giving flexibility that for us we don't view it as increased risk, just flexibility that sometimes banks cannot or other ones cannot. Get paid for it, and we don't view it as additional risk. So that flexibility is definitely key for a borrower. Another reason why a borrower will want to use it, if he wants to make amendments later on or want to make changes. It's a lot easier for 3 of us than if we're 100 of us. So there are many advantages for a borrower to come to see a private lender in its mind. So that explains why private credit grew.
Can I jump in for a second with a mild rant or anecdote? If that works?
Go for it.
So I think a question that I often got from particularly our risk folks and some of the portfolio construction teams at different organizations over time is this idea that the markets are incredibly efficient. And so when I'm getting a higher return, particularly in private credit, that must imply that there's something scary or riskier inherently about this particular opportunity. And to some degree that's true, but I really want to go back to that value proposition to the borrower. Many of these borrowers, they're not thinking that they're being punished, that they're overpaying for credit by 200 basis points compared to a very liquid bond portfolio. They don't care. What they're getting is a much more cost-effective, they're saving 100, 200, 500 basis points of cost against raising equity from a possible face-ripping private equity fund.
I don't know of any.
Sorry, is this being filtered for publication? So they're getting private equity style engagement, alignment, support, due diligence, flexibility, execution certainty, and they're willing to pay that higher premium for that enhanced experience and for that partnership. And so that inefficiency, it's a very real and tangible thing, and that's really what's creating much of the value, that spread that you're seeing in the private markets on the credit side relative to those more liquid and sometimes more volatile public benchmarks.
Yeah, I think that's an excellent point, and I can see Tony just ready to get in there, but I'm going to actually ask you to hold your comment for a moment.
But I'd like to comment on a couple of things.
I have some thoughts about it.
Okay, go for it.
So one of them is on the growth of the market, right? On the demand side, there is a lot of growth because, at least in the US, and I think it's true in Canada too, the number of small business formation has skyrocketed over time. And for a lot of these small businesses, you know, the advantages you talked about, why it's advantageous for the small business are certainly there. But let's face it, they have no alternative, right? The banks won't touch them. And therefore, this is a market that supplies them a credit that they just have no other alternative of getting financing.
Bank consolidation.
Also true.
Right, but also, so there's bank consolidation, but the amount of business formation has skyrocketed in the last 10 to 15 years. So that's a natural growth for the demand side. On the supply side, there's a lot of people looking for alternatives to capital deployment. So you might have an investor that is looking at the whole spectrum from a two-person startup all the way to an institutional, long-term institution. And a lot of the asset managers are looking to fill different components of that spectrum that wasn't there 10, 15 years ago. The average asset manager, especially in the public sector like pension funds, really stuck to the public markets, right? And maybe it's more than 10 to 15 years, but that was their bread and butter. Chasing yield, they went to different alternative markets. So it's both the supply side and the asset side. Part of it that has made this market a very vibrant and growing market.
Well, thank you. And I'm going to, all very good points. And what I might invite you to speak on is about the capital matching. So that's something that private credit can offer that is different than the maturity matching that you can find at banks. So before we get into sort of the credit profile and some of the risks and how we manage them, I'd like to just have our panel speak a little bit on the matching side of things and how that maybe drives some of the momentum on the investor side.
I can go. I mean, I took out a quotation from Michael Milken last year, and just on that topic. So he said, how many times, how many decades are we going to learn this lesson of borrowing overnight and lending long? Whether it was in the 70s, 80s, 90s, I expect more disintermediation, end of quote.
It's so relevant, so relevant, yeah. Tony, do you have anything to add on that? If not, we can move right into credit.
Banks have sophisticated ways of managing maturity mismatch.
Yeah.
That doesn't mean that those sophisticated ways of doing that doesn't get into, especially when you have dislocations in the market, that banks do run in trouble. So yes, it's a lesson learned over and over again, but I would say that's true of most risk management, right? Yeah. The instances are different, but if you step back from a bigger picture, whether it's credit, whether it's market liquidity, whether it's mismatches, those are things that as the cycle gets, as the cycle is very favorable, things are going well, people get complacent. That's one thing that leads to the lesson that needs to be relearned. But also, it's the people who are managing that, and this is an interesting point for this private credit, is how much experience do they have when they have large downturns in the market, right? So when things are going well, one could argue little bumps on the road, but since 2010, the exact date doesn't matter, things have been going relatively well. But how many people have experience with really significant downturn like the 2008? And one of the things that the banks bring to the table is that they often have that breadth of experience in dealing with when things go really bad. And so it's not just banks don't touch them for regulatory reasons, and I know later on we'll get more into what I would call more regulatory arbitrage as opposed to, this is a regulated market, this is an unregulated market, then you have the ability in the unregulated market to do things that you can't do in the regulated market. But step back and just say, these regulations, do they enhance your risk-reward trade-off? Now, we might say some of it does and some of it doesn't. So let's leave aside the part that doesn't, which would be what I call regulatory arbitrage. In other words, if I, as a prudent risk manager, would allocate a different amount of capital to that particular transaction or portfolio because I just see the risks differently and therefore the regulations are making me have unnecessarily higher capital. I call that regulatory arbitrage. But if you look at, leaving that aside, if you look at the portfolios, private credit, you would say, why wouldn't you put the same amount of capital a bank does? Apart from the regulatory arbitrage, but there are some of it. So, the fact that it's an unregulated market doesn't take you away from a good risk management that says, listen, these are generally much higher risk. And that's one of the reasons they pay more, because no one would do it if it paid the same as a lower risk transaction. So is the risk-reward trade-off taken into account sophisticated measures of risk? Is the risk-reward there? And often, for a lot of the transactions, it is there. I have no direct line of sight into what of the current portfolio of private credit, how much of it is the risk-reward trade-off is actually there, and therefore, yeah, you're taking a high risk, but you're getting paid. So over time, it will, you'll have dips, and provided you could survive as a fund when it does dip, if there's that survivor issue that one needs to take into account, because the depth of capital behind this is limited. So let's assume you survive those dips. Over time it'll pay off. But for the other component of the portfolio that really is too risky and it's not been priced well, then that can cause a lot of problems and dislocation in this market.
Thank you, Tony. And John, you'd like to add on?
So a couple things. We talk about why people get into it. When I talk to folks that are using private credit or private equity, I always hear the word, it's like an insurance policy. I always hear that term. And they never believe that it's a higher risk deal. They believe that they're buying an element of freedom relative to the terms and conditions of the transaction, which I think private credit can do better than the banks. And simply because there's an element of agreeing to the terms and conditions in a set of documents that are more flexible to help the person. So that there's a positive there, or help the company. On the recovery side, when something goes bad, Tony, to your point, I'll tell you, on any transaction that we've been involved in, or I've been involved in outside of Meridian in my past lives, where private equity or private credit has been involved, a far more diligent and easier process in negotiating to try to get out of the deal, because the people know the deal far better than a bank does. Their diligence, so private credits, as you had said, Jérôme, their diligence is far tighter in what I have seen. So in negotiating to try to get out of the deal or get a refi done, it seems to be a smoother process. Or it seems to be a faster process to saying, no, we're going to put a bullet in this transaction. So those are two things that I bring up, because the learning for us has been, there is extreme focus on when we're involved in a private equity deal, or when private credit is secondary to our senior debt stack, where we make sure we understand the private credit side very, very well, because we don't look at it as they're getting paid more and that's a bad thing. We look at it as an element of it's behind us, and it's almost a bit of an insurance policy for ourselves as well.
I want to touch back on the actual risks inherent in the debt structure of private credit. And they can vary depending on the type of credit we're talking about. But generally speaking, I mean, you've highlighted the benefits to the client as well as to the institution that's providing the capital. What about the inherent, like, structural and put the pricing aside for a moment, but the actual structural risks that are, you flag, or the characteristics of the types of companies that are looking for funding from private credit? Are they significantly different from a senior bank lender client? And I think they are, but I just want to highlight them for our audience here.
There are many things you mentioned, and I'm keeping my mouth shut just not to. Because well, let's go with, they're different, not necessarily competitors, but different, because private credits could be, I told you the sectors, but also there's also investment grade and there's also non-investment grade. So you can spice it the way you want and you can choose your sectors. So let's start with banks. Banks have 10 times leverage. Private credit fund has 0 or up to 1. So the level of spice that a bank can take is not the same as the level of spice that I can take with 0 leverage. So in the spiciest, and we'll go on the spiciest, which is financing leverage buyouts. It's a little bit spicy. So it's true, they don't participate in the level of spice that I can do. But they will participate because they are in that market. They do the originate to distribute model. So when I compare the non-investment grade private debt that I do, I compare it to the banks, which they cannot keep it on their books. They got to sell it. So that's what I mean by better due diligence, better knowledge, better pricing, better structure, because that thing that I'm competing with the banks, they offload it to the public market. They cannot keep it because they got their risk is different than us. Okay? So it depends on the spice. And we'll go back to, so now let's talk about spicier.
Okay, let's go
So,
for it.
I mean, many times I hear about private credit and people say stuff that all the risk in private credit and not in public markets. For me, it's not true. You got risk everywhere in the spicier stuff. It's spicy, the banks do it, they go to public markets. I'd say read their docs. It's really loose. So you got risk everywhere, okay? But sometimes I read stuff that I said, oh my God, and it's not true. Sometimes I read, everyone seems to know these private credit deals are junk. It's not true. We negotiate it. So it's not true that you can generalize that private credit is risky and public is not. And other times there are plenty of potential pitfalls. Wait a minute, I know what I do. It's risky, but the public side is also risky. So what do you do? What is the typical transaction? I'll talk about corporate, but you can do about other sectors. Obviously, you got more leverage because we finance leverage buyouts. Okay? So it's sponsor. So if you put a financial risk, I will not be stupid enough to have operational risk high. That's the criteria for disaster. So if we focus on stable sectors, insurance, healthcare, software, everything that's stable. And to be honest with you, I know I'm in a risk conference, the difference between a good debt manager and an average debt manager is not the extra basis points I will get on a transaction. It is your losses. Protect the downside. That's the difference. So you got to make sure you choose the right sectors, the right company, the right sponsors, because you will have financial risk high, because that's a leverage buyout. So typical transactions, you'll have, let's say, a software. You'll have a loan to value initially below 50%. You will have a leverage 5 times in that area. And we feel like the cash flow generated by that company will be enough to pay you off. But you got initially cushion. So to say that private is risky and public is not, no. Everyone has risk. Now, how do you structure it? How do you understand it? How do you manage for it? And then we'll go about stress tests and portfolio management review and knowledge of the company. But risk is everywhere. So it's not true that one is not. That's the message. Mm-hmm. And so I'll stop
Thank
here.
you. Yeah, no, that paints a picture of what are the flavor and the spice. Of the different types of risks that we might be willing to take on and for what reason and what are the other considerations. Now, the banks have really mature workout groups. They are armies. I've worked with them. I've worked inside them. I've seen how they operate. Now, how do the private credit markets operate? Are they ready to withstand a potential downturn in a credit cycle? And how do they manage that? John, I'm going to start with you.
Sure. So I've worked in the banking system with the big banks in that specific with that specific group, and it is focused, and number of files per, the ratio is very, very tight. There's a learning curve for that group to get up to speed on that specific file, whereas in the private credit group, most times, that person that was involved in the adjudication of the deal is also working it through the workout. So there is this, I think, false impression that private credit doesn't have the infrastructure in place to follow through on a transaction to make sure that they can work out if they have to work out. And the ones that we have dealt with, I'm going to say that's not been the case. They have the infrastructure in place. They have the know-how. Their ratio of files per person is much less than the big banks, and the big banks are churning. At the credit union, we are churning as well, not at the same level. So I think the infrastructure at what I would say the reputable big private credit, private equity firms, the infrastructure is there because they have the funding through their return mechanisms that they make to put the right risk elements in place, or overarching enterprise risk management protocols in place with a real deep level of collections.
Can I jump in
I
for a
was
second
actually
on
going to
that?
ask you to comment on that, especially from
I'd be
Avondale
delighted.
Capital's perspective.
Well, thank you. But no, I think one thing that is worth emphasizing as well, and it's surfaced in a couple of the comments already, is the quality of partner, quality of relationship, and most importantly, I think, alignment. And so when I think about more corporate, large-scale operators in lending or otherwise, they have strengths and size and resilience as well. But I don't know if people fully appreciate the depth of commitment that comes from having your entire personal net worth tied to the portfolio that you are forced to manage. So if you're a partner in a private credit shop, your house, your livelihood, everything that belongs to you is tied to that fund. And if your partner screws up, you're going to get burned as well. So the amount of cooperative and enthusiastic oversight that happens in those organizations cannot be overstated. And so that applies to not only the private credit operators themselves, but to the sponsors whose equity and houses is below that, in fact. So when you hit the skids, when things are not going well in those companies, they don't always come out the other side. But the energy, enthusiasm, creativity, resourcefulness, and effort that goes into working them out comes from a place of pretty deep commitment and alignment. So I just wanted to kind of make that maybe
Thank
overly
you.
loud
Yes,
point.
and I would love for Tony, for you to follow up with a balanced view on the banking perspective of some of the century-old practices that have been put in place by our big banks.
She prompted them with the word balance.
Century old, but modernized continually.
In a good way.
In a
Yes,
good
I
way,
feel like it's
yes.
a good
So there's a lot of depth there, but
Yes.
it's
Well,
also modernized.
A lot of expertise
Yes.
and knowledge
Yes.
and history.
Yes.
That.
So a couple of points related to that before I get to your direct question, which is around, for sure in private credit, the portfolio to the number of companies you're following to the individual credit manager is a lot lower, but that translates to a higher operating costs, right? So how much of the higher margin, some of it has to cover risk, some of it has to cover your higher operating margins. Partners get paid a lot more than the typical bankers. So that margin gets eroded. So how much of that actual margin, it goes back to risk reward trade-off, is you're actually getting paid for, right? And how much of it is getting eroded? Like there's a reason why, for example, credit card interest rates are high, because the costs associated with administering and fraud being a big component of credit cards erodes that big margin. So it's not like banks are running away mad with 20% return on their invested capital for credit cards. It's actually the margins are quite thin when you take all the costs into account. So one of them is, take all the costs into account, fully loaded, how much is your net margin left? The other thing is these things are not binary, right? I just want to make sure that we don't get the impression, this is risky, this is not risky. It's a spectrum. So of course, by its very nature, private credit is going to be more risky than a typical bank credit for a corporation. Because part of it is self-selected, as we said. There's a number of reasons why banks don't get involved in that market. And there's a real need. So it's not like the private credit market is a bad thing. It's actually a very good thing. Right? We just have to be aware of the risks. Are the risks being compensated? And we have to understand, do they have the depth of infrastructure, if we want to call it that, in terms of risk management, in terms of due diligence? Yes, you do a lot of due diligence one-on-one, but one of the reasons why the banks can get away with kind of routinized, although it really isn't that way. I mean, there's a lot of customization of the due diligence, but it could be somewhat routinized because we may see 10,000 transactions, depending on the size of the bank. It could be in 6 months or it could be in a year. Whereas in private equity, they see only a few transactions, right? And I've seen, as I transition, let's say, from a big bank to more private equity investing, there's that, the number of transactions I see now versus the number of transactions I saw before is significantly different. And that depth of spectrum of transaction gives me a lot of experience that I now don't have, right? So if I hadn't worked in a large bank before, doing what I could do now would be impossible. And so part of my question is more on the operational risk side of running a private equity, a private credit, private equity, pretty much the same. Is the risk that they're taking on because of the depth of the experience, the sophistication of the risk management tools, and it's not that they can't build that up, but every time you build that up, you're adding to cost, and so you're reducing that margin, and then it goes back to, are you getting paid all-in costs, fully loaded for that, for the risk you're taking. On the partnership side, fully agree. It definitely gives you the right incentive. However, as a risk manager, I always look for counterfactual, right? So you say, and we have my former employer has direct experience of that. So Salomon Brothers was a partnership. Their wealth was tied, and we're not talking about small amounts of wealth, huge amounts of wealth by each partner was tied up in that partnership. It blew up, right?
Russia.
It blew up. So Citibank came in and at the end of the day, kind of bailed them out and incorporated them as part of Citi. But so I definitely agree. Long-term capital, right? Not only was the intelligence there, but also their private wealth was tied up, and 90% of their private wealth for most of the partners was tied up in that fund, and yet it blew up on something that was relatively not a lot of risk, but the hidden risk there, the risks that can only be revealed through stress testing, and the right kind of stress testing, were huge. And it's the same thing, I think, as an outsider observer. So I would say I have no direct insider knowledge, but as an outsider observer, it strikes me that the traditional observable risks are probably well managed, but what about the hidden risks that can only be revealed through plausible but significant stress testing? So I'd like to hear from my colleagues how they handle that risk.
Well, maybe one thing. I agree with most of what you said, but one thing I don't agree. Private credit is not necessarily riskier than, it's true. When you put spicy, I agree. But let's take banks, non-spicy. Sometimes, depending on the markets, they say, I cannot go beyond 5 years. They call me, same project, investment grade. I'll go 7 years. You know what? And I want an acquisition facility to give me a permission to do a delayed draw facility. I'll give it for you. So it's the same risk. Banks, sometimes it's 3 years because the market's sometimes it's 5, cannot go longer. We talk about Michael Micken. I can go 7. Same risk. It's not more risk. It's and I'll give a little bit more flexibility, and I get paid for it. So sometimes it's riskier, sometimes it's flexibility I give you that you want, that the banks cannot. So it's not necessarily riskier. That's my point. Sometimes it is. Sometimes it's not. And on the workout group, 2 comments. Private lenders, they got PE firms. They got operating partners. They know how to manage firms. They own companies. So when a company goes bad in the private lending firms, it's a SWAT team. And they know how to own company. They know how to turn around company. So I'm not saying, and we get a few files where banks are involved. It's seamless. Both have experience. And I'm talking about the bigger firms. I'm talking about the big firms. It's not me individually. It's the big firms. Mm-hmm. It's seamless. Both have experience. Banks do have it. Now the private lenders have it. And one thing that's key. Let's say you're giving a mandate, like we do majority of our own investment directly, but we give a few mandates to private lenders, a few GPs. Definitely, workout expertise is one criteria. Definitely. To give you money and you don't have workout expertise, probably would not give you money. So what's interesting is now the money received by the GPs of private lending is shrinking a little bit. So you got less money given to GPs at the moment in private credit. So it's reducing. However, the top firms, top 6, it's increasing. Mm-hmm. Why? Because probably an LP like us would say you got a great origination capacity. Mm-hmm. You got a great relationship, great network, great credit, but also you have workout teams. So if I'm by myself, I would be struggling raising money now. But the big firms, because they had origination, workout, they're increasing while the market's reducing. So gives to your point, I think both of them have expertise. Mm-hmm.
You see that in the VC market too.
Yeah, that's an excellent segue into our next topic, but I'm gonna let everyone know Alexi has a mic, and we're gonna open it up to questions in just a couple of moments, so get your questions ready, and I'm gonna kick just this last question off regarding financial market stability. So we've talked about the rise in momentum and volume and the significant role that private credit is playing in the market. Do you think that there are any financial stability concerns with this recent rise and like the strong presence that it's playing in our financial system? Tony, why don't we go to you?
So I don't see it as a direct threat to the stability of the financial institution. But if this market, the private credit market, were to experience major losses and they start pulling back, it's the spillover effect on the economy, right? So let's say we're going into a mild recession, and that mild recession in a scenario where the private credit, a few of the less well-known, well-managed firms blow up, because that's usually the first to go down, right? It's the ones that are not doing all the due diligence, don't have this sophistication. They start blowing up, and that causes spillover effect. And there's a lot of interconnections, right? Let's face it, there's a number of banks, especially in the US, a lot of banks are actually indirectly financing the private credit. They're involved in the deals not as limited partners, but they're often funding the funds through the funds that use leverage, and therefore they're involved in it too. And they start pulling back. So it's that spillover effect that just creates what could be a small contained problem into a problem that is getting bigger and bigger and bigger. And that can convert a mild recession into a deep recession. It's sort of what started in the 2008. If you look at, it's quite fascinating to understand the evolution of the 2008. A lot of people, when you first look at it, especially if you weren't involved, it's sort of like a big bang. You know, you woke up tomorrow morning and you find out everything's blowing up around you. But it wasn't. If you go into the summer of 2007, things were starting to deteriorate, right? And there were a lot of concerns in that market that maybe things are not as good as they seem on the surface. And then we saw little blow-ups and little fund here and another blow-up here. And some of the, Smith Barneyans and others of the world were having trouble. And all of a sudden it became all those spillover contagion effects because the financial market are all intertwined and interconnected. These things can blow up. So my concern, let's say if I was still a chief risk officer, wouldn't be so much about the the direct losses associated with private credit. It's more the spillover effect.
Mm-hmm. And there's a Margin Call and a couple of other really good films that kind of demonstrate that point, and they're quite entertaining, as long as you weren't involved. John, I'm going to go over to you, and then Alexi, I think we have a question in the audience.
I appreciate, Tony, what you said, and for me, when I watch the market, again, $27 billion credit union, different stage in where you folks are at. But when we watch the market and I see liquidity at a high level, then people start chasing deals, whether it's private equity or whether it's or private capital. They start chasing deals. Then the knockdown effect, to your words, I start watching that and I sit there and I say, well, how can they do an 8 times PE deal or a 9 times PE deal? So then we start looking at our risk appetite and saying, should we revisit it? And our answer is always no, by the way, as at a risk conference. We always say, no, we're not revisiting our risk appetite, because our risk appetite is what got us to where we are to be $27 billion. But that knockdown effect does boil itself down to the sweet spot where we're at. Whether it's a $300, $400, $500 million deal and we buy our piece, we start questioning why is the ratio, the PE ratio where it's at? Why is the margin now coming down? Why is there competition from a private capital on a senior debt stack deal? Those are questions that make us pause for a second. And what we never want to do as a credit union, we're on the call sheets for all the big banks. We want to stay on the call sheets for all the big banks. We work very, very well with them. But we can't be slow. So you have to have that pinpoint expertise to make sure you can respond in time sufficiently with the data that you have. But when I listen to everybody speak, the one thing that keeps coming to mind as I hear everybody is when liquidity is high, people chase. And when liquidity is low, then it's harder and it's harder, and margins go up. So I just wanted to add that to your comments, because I think it goes very hand in hand.
Thank you. I think we had a question in the audience.
I think you actually asked it, which was what is sort of the systemic risk
Oh.
embedded within private credit growing. So
Great. Please, go ahead.
Yep.
One here, and then we'll go back.
There's some over there too.
Hi, I'm Oya. Being on the banking side, I felt Tony was left alone a little,
but he did so well.
but I really appreciated actually the value and the space that the private credit fills in, because I did not have that appreciation before, so thank you for your comments. It's just that I'm also curious about, this banking versus private credit going forward. Like, do you see them competing? Because you mentioned, spectrum that the private credit may fill in, investment grade, etc. So do you feel them competing? Or recently, there were some announcements about credit and banks collaborating and partnerships. Do you see them maybe working more together? So how do you see, I guess, those two spaces?
Yes, more and more. Yes, more and more.
Collaboration.
Yeah.
Yes,
Let's say on the non-spicy. Let's say on the non-spicy,
For sure.
there are banks and private lenders. So absolutely, they work hand in hand. And even on the spicier stuff, they work hand in hand. And I'll tell you why. Last year, capital markets were closed. So 80% of LBOs were financed by private credit. This year, probably all-time high issuance of leverage loan in the US. I got some transactions now. Part is the banks issued at the public markets. Banks, I got part of the transaction is private. So absolutely, I think where it's going, I think you will see more and more together. And it's already starting, so absolutely, I see it.
I think they're complementary.
Exactly.
They're not competing with each other. They're complementary. Now,
Sometimes they're competing. Let's say transactions, so I want to win, and then he's going to provide you a solution, I'll provide you a solution. But
they're
sometimes you say, I'll go both ways.
When done
general.
right, it's complementary.
Yeah, in general, they're part of an ecosystem, and
Exactly.
they're
Yes.
both needed. There's a question at the back.
thanks, Oya. That was one of my questions, like the engagement that you've seen between Apollo and Citibank now, I guess, is a good example of that in the market. My other questions were, like, with all the benefits that you've mentioned in private credit, the market is also getting crowded in this space, and we see spreads coming down significantly. So I just wonder, like, as you mentioned, documentation, flexibility, all the reasons that illiquidity premium, all the reasons that private credit arguably gets paid more for, is that still there the way spreads have been coming down?
Is there some yield compression?
Your question is absolutely right on. You got to look long term versus now. Now, there's a lot of money in the private credit space. We said it, 15% growth. Also PE, but at the moment, there's a lack of transactions. There's a lack of supply. So your point is absolutely good. So not enough transactions, all of us, too much capital, all of us now is after the same transactions, way too, not enough of them, spreads are coming down. Docs are way looser. So your point, at the moment, totally right. And just for example, usually private equity firms they've owned companies for 4 years, in average. Now they're up to 6 years. This is as much as high as, because they cannot sell. There's a mismatch between the buyer and seller. So when there's going to be a match between the buyer and seller, PE firms have to sell because ultimately they got to return money to their LPs. That's going to be a ton of transactions. So maybe now lenders like us will have a better balance in the transaction. But at the moment, you're totally right. There's way too much capital for a lack of transactions.
Yeah, and maybe to build on that too, I think, credit markets are driven by fundamentals in terms of the actual businesses themselves, how well they're doing, how well the economy is doing, and technicals. And the technicals are often the supply and demand of capital generally. And so now it's also a game of comparables, which is on the public credit side, technicals have a much bigger effect as money flows in, money flows out. Spreads are often whipped around by those shifting and asset allocation decisions. I think you do have a better shot at accessing the fundamental aspects of lending through the private side, but you're not immune to that supply-demand imbalance in capital. But putting in a small commercial, though, I would say for some of the stuff that I've been looking at lately, though, it also cries out for a bit of innovation to find markets that aren't just regular way corporate credits being invested in by private equity. It speaks to the opportunity set in infrastructure lending, I would say selfishly on the sustainable credit side, and a few other spaces, but that better beta opportunity to take some of that surplus capital and build other parts of the economy that deserve it. I think that's part of the opportunity that we're hoping for and looking at right now.
Thank you, Christian.
And just to add on, in terms of the stability of the market, spreads are we know that. The spreads are going to compress, they're going to expand, compress and expand. To your point, you got to be in the game even when the spreads are not there, because if you're not there, then you just won't get the business flow in the future. But it's a very tricky balancing act, and my former employee knows all about that. It's like if the music is playing, you can't stop dancing. Well, at some point, you do have to stop dancing. But from my sense, again, as an outside observer of this market, I don't think we're there. I think we're, the fully loaded cost, and I keep saying that because sometimes we just look at the credit spread, but you have to look at the spread net of all the other costs. And those in private markets are much higher than in a bank because they can spread out those costs much further. So if those are getting to the point that right now you have are not as profitable as they used to be, or maybe are a loss, you have to look at it. Is this a trend that's going to continue, or is this just the cycle? It's a normal cycle. If it's part of the cycle, you continue. If it's a trend, then you'll see pullbacks.
Yeah, good point.
Thank you. So I think we actually are almost out of time, but I did want to, we have 2 minutes, great, because I wanted to touch on one more question that we've all talked about and I think come up in conversation quite often, which is, do we need a regulatory response to the private credit market given the rate that it's grown at and the space that it takes up within our capital markets and our financial markets? So John, I'll let you have the almost last word, and then we'll see who's biting to the punch for
and
the
I
last
may
word.
move over because I'm not looking to get a punch from. No, I'm going to say this. I mean, we're in the credit union space, so for us, we work under a FSRA regime, which has worked very well for the credit union space. We are not the front end of private credit, so as a result of us not being the front end of private credit, it would be wrong for me to put a position on it. But the system we work within right now works for the credit union system in Ontario and the bigger credit union system in Canada.
Excellent. Tony, do you want to weigh in?
I think the market should not be regulated. I think it's doing fine on its own. There is a regulated market for credits, and that's the banking sector, and you know, some of the pension funds are regulated under FSRA and on other aspects of it. But you know, that market serves a particular need, and well done right, it actually contributes to you know, economic growth and all the prosperity that goes along with that. So it fulfills a really good service to the economy as a whole. Regulating it would just, if you regulate it, you got to do it, you got to justify it to regulate it as much as you do the bank. So basically you're killing that market. That doesn't mean that, you know, there should be some level of more like scrutiny in terms of making sure the disclosure, so regulated maybe from an OSC, I guess it's called here, or SEC kind of regulation, but not the kind of banking regulation. Yeah. It's more about disclosures. The people know what they're getting into. Mm-hmm. And as long as that, I'm fine leaving them the way they are.
Well said. Yeah. Christian, would you like the last word?
Yes, I guess from context, yes. It's hard to top what Tony just said, so I think I'll be very brief. I think transparency does absolutely make a lot of sense, but I think if you do over-regulate anything, you risk unintended consequences. Even with the best of intentions, I think you will probably drive capital to other illiquid and less transparent parts of the horizon or the spectrum. So I agree. I think you got to make sure people can make the appropriate informed decisions as capitalists and responsible investors. But ultimately, you need to preserve that entrepreneurship, that dynamism and innovation that we've come to expect and benefit from collectively thanks to private credit.
Excellent. Thank you. I'd like to thank all of our speakers for really providing like a comprehensive and balanced view on the topic of private credit. And I'd like to invite everyone back to the plenary for our next session.
Good for you. Well done.